Okay, we're going to get started, guys. My name is John Murphy. Thanks for joining us. This particular webinar is going to be on creative financing options for the self-employed borrower, which also means real estate investor. It started out with having 7. That was the advertised amount. By the time I got done, there were 11 loans we're going to talk about today. We're going to move quite quickly here because we want to get this done in the next 35, 40 minutes, and that's a lot of loans to talk about that time. So what I want you to do is to consider this your opportunity to help select the next webinars. This is like a survey right now that we're going to have. So the particular loans that you want to dive deeper on in a future webinar. And we're going to use your responses to help us determine what webinars we're going to have in the future, which loan products you want to hear in the future. So if you are a self-employed borrower, to us is someone who owns a business, owns part of a business, or is a real estate investor or any other kind of investor, that kind of a client. So they have variable income typically, and it can be a little challenging for them to get a loan to purchase a home. So that's what we're going to talk about today. We're going to talk about how to get a self-employed borrower, any of those 3 kinds of individuals, into homes for property. If you're a real estate agent and you want to work with self-employed borrowers, it's probably relevant to know that according to some data that was put out by CoreLogic, nationwide over the last year, 26% of the homes were purchased by real estate investors. And a real estate investor is one of the definitions we have for a self-employed borrower. So 1 out of 4 homes goes to a real estate investor. It's a fairly large market, a very significant niche market, I think, that you could take advantage of. And it's more challenging for the real estate investor. It's challenging because of income. So generally, things you want to know about loans is that income typically needs to be verified. I'm going to show you one loan where we don't verify income, but it's obviously more expensive and it has some restrictions as well. Down payments need to be verified as well. And all of the loans we're talking about here, that's something that's generally speaking we need to do. Verification means that we need to either season some funds for 60 days, so we get 2 months worth of bank statements, or we're going to source the funds. People have sold jewelry, they've sold cars, they've sold houses in order to get funds for a down payment to purchase a home. You can borrow on real estate. One acceptable place you can borrow is a home equity line of credit or even a first mortgage on your current real estate to get a down payment to buy future real estate. And gift funds can be acceptable for the down payment. However, keep in mind that there are restrictions there. Credit scores are important. Your loan to value is determined by your credit score, and the loan to value itself can be reduced. If you have a lower credit score, you can buy more home if you have a higher credit score. And the rate is impacted by the loan to value. So in other words, the very same client with the very same credit, the same income, and they're purchasing home. We have owner occupied homes at, let's say in the alternative lending world we're going to talk about here, at 90% loan to value. The rate would be different than if it was at 80% loan to value. So if you put down 10% down payment, the rate is higher than if you put down a larger down payment, 20% down, and have a lower loan to value on the loan. All of those things are true with all the loans that we're going to be talking about here today. And reserves are important. Reserves, in this particular case I'm talking about, is the excess funds that you have that you do not need to use to close on the purchase of the property. Many of the loans we talk about today, and I may not talk about them with a specific loan, require a certain amount of reserves. It's usually like 6 months of the new property's payment. So your principal, interest, tax, and insurance payment in some account. It can be in your business account. It can be in your personal checking. It can be a retirement account. But the lender doesn't want to take all of your money, and there's a certain amount of reserves required for loans of this nature. One last thing, this particular lending scenarios we're going to talk about, which I call alternative financing, is a world of exceptions. So if you don't fit inside the box, if you don't fit inside the Fannie Mae conventional loan box, that's why you're in this world to begin with, because you don't fit there. If you don't fit inside the box for the particular loan we're talking about, then this world, the lender oftentimes will look at it and do an exception for you. The exception may mean that the rate's a little bit higher because they're doing exception, but sometimes not even not. So if you don't fit in the box I'm talking about, it's worthwhile talking to myself or a qualified loan officer that knows the loan program to find out how we might be able to make it work for you. All right, so the challenge with most self-employed borrowers is income. because you have this different challenge going on here, showing your income to the IRS and increasing your taxes because you have larger taxable income. And you want to reduce that, so you increase all of your expenses and reduce your net income. But then when you give it to the lender, us, and you want to qualify for a loan, we believe what you told to the IRS for your qualifying income in the conventional world. We're going to use the net income. And if you don't have enough net income, you don't qualify for the loan. So it's a challenge, isn't it? So there are other ways to do it. We're going to talk about that, and we're going to kind of blast through these 11 ways. The conventional method of purchasing a home with a self-employed borrower is 2 years of tax returns. We're going to use the net income. We can add back certain things such as depreciation, non-taxable items, capital expenditures. We can add back to income. Capital expenditure is defined as an expense that happens maybe once every 5 years, like you replaced a roof on one of your rental properties and it costs a lot of money. You're not going to do that again for a number of years. If you can show a capital expenditure and document that very, very well, you can add that back to the income and increase your income from that, which means reduce your expenses. But 2 years tax returns have problems. You can have variable income, and many self-employed borrowers had declining income over the last couple of years. And if an underwriter sees a declining income, which means you made less money, noticeably less money on your tax return this year than you did the prior year, they're not going to use the prior year. Normally what they do is we average income out over the 2-year period for a self-employed borrower. With declining income, we're only going to use the one tax return, and that it's declining, so you get less income there. One way to handle that is to do 1-year tax return. And that can happen in the conventional world as well. There are some rules around that. Typically, you need to be self-employed for 5 years, and then we can conceivably use 1-year tax return. However, I had some self-employed borrowers that closed just this month that we used 1-year tax return, which was significantly better than the previous year. And they were not self-employed for over 5 years. But what happens is we run the conventional loans. These are loans that are purchased by Fannie Mae and Freddie Mac through what's called an automated underwriting system. And if the automated underwriting system tells us we can use 1-year tax return, the lender will do that. And in this particular case, because of their credit, because of their reserves, and because we kept the debt to income ratio down below a particular amount, the automated system said we could use 1-year tax return. We did for them. That allowed them to buy an owner-occupied home with a 1-year tax return and not having to use 2 years. And it was very advantageous for them. So both of those ways of verifying income are in the conventional world. But let's assume that those don't work for you. Now we're going to get into the non-conventional world. I call it alternative financing. It's also called non-QM, which means non-qualified mortgage. And we can talk about what that means at another time. But it means conventional is not going to do it. Fannie and Freddie are not going to do it. A common way of verifying income is with bank statements, because bank statements show deposit activity going through the bank account. And if we can average out that income over a 12-month period, that's the minimum number we typically will get, although I'm going to show you some options at least split around that will be less than that, or a 24-month period. That's a very good indication of what a business produces for income or what an individual has for income rolling through their bank account, even if the tax returns don't support it. So instead of using tax returns, we use bank statements and we average out the income. Now, it has to be acceptable deposits. You can't put stuff in that we don't understand what they are. Large deposits, which are out of the ordinary, are probably not going to work unless you can source and show those are part of your business. Here's some general guidelines on this, okay? 12 to 24 months business bank statements. You can use business or personal bank statements. If you do use your personal bank statement, you can use 100% of the deposits that go through, minus transfers that don't look like they're real income for you coming into your personal, minus anything that looks out of the ordinary from an underwriter's perspective. And they're going to back it out if they don't understand it. But what you can do, of course, is you can support what that deposit is with documents to show that it's really income coming through your bank account, and then we can potentially use it. So 100% of personal, but on the business side, there's an expense factor because it's a business. And typically we're going to use 50% of the deposit. So we have a 50% expense factor. That means if your business average deposits over that 12-month or 20-month, 4-month period was $20,000 deposits we used, we would take 50% of that and you would have $10,000 a month of qualifying income for the loan. Now, you can have a lower expense factor if a CPA will agree with that and write a letter for you saying that Joe's business really has a 20% expense factor, which means 20% of the funds that roll through your bank account are used for the expenses. That means that 80% can be used by Joe to help purchase a home. If the CPA is willing to write a letter of that accord, we can potentially use that. Also understand if you have multiple businesses, we can use multiple business bank statements. We'll just take 12 months for each business. We'll average it out for each particular business, and we can use that for income. And then understand that once you have business income and bank statement income, you can add that to other income. So for instance, I have a client right now that is self-employed with his trucking business, doesn't quite qualify for the loan on his own. His tax returns certainly don't do it. So we went to bank statements, and they had more income when we averaged it on the bank statements, but not quite enough income. So he had a relative step in that has W-2 income and some Social Security income. We use that income, and this is called a non-occupant co-borrower. The relative didn't even have to occupy the home, but they co-signed on the loan. We combined the incomes together, and it worked for them to be able to move forward and do that loan. That's bank statements. So if 12 months doesn't work or 24 months don't work, but the last few months have been really, really strong for your business, you can potentially use the most recent 2 months of bank statements, business bank statements, along with a profit and loss statement prepared by a CPA. Okay, so the P&L is for the most recent 12 months, and that's why this particular program can work as opposed to a profit and loss statement for the previous year. Because remember, the CPA is going to have to prepare this. We believe what they tell the CPA, and CPAs are very, very careful on what they report, and it's going to have to be on their letter and all of that. So they might do a P&L for the previous year and not have nearly as much income, but now 6 months have gone by or whatever, and the business has really kicked into gear. But if we were to use the P&L for the previous year, which would be a normal loan, it doesn't work. But the previous 12 months, if you understand what I'm saying here, which is not just the previous year, does work. So if you get 2 months of bank statements and the profit and loss showing that the business has been doing good over the last 12 months, we can potentially do that. The deposits go into the business account, and what we're going to take a look at on those 2 months of bank statements is to make sure that the deposits going in there are greater than or equal to 85% of the gross income shown on the profit and loss from the CPA. So that's our double check mechanism. You see, CPA prepares a profit and loss. It's got gross income, expenses, and we use the net income to qualify. We're going to take the 2 months of bank statements and say, does that equal on a monthly basis what the gross income shows on the profit and loss? And if it's within 85% of that, you're good to go. If the business the last 2 months potentially doesn't have the 85% of the gross income, you can add bank statements to that. So maybe the prior 4 months would look better and the last month or so wasn't good. But if we look at all the 4 months and average that out, it still hits the 85% mark. So you can see there's some variability here. Underwriters are really just trying to understand and get a good grasp of what the business is producing for income, or what the personal tax return is producing for income if you don't have a business bank statement, so they can really understand that you have the income to support your payment for your loan. And they're doing their best to do that. And underwriters really do, contrary to popular opinion, want to make loans work. That's what their job is, really. Okay, so that doesn't work. What's another option? Well, 1099 statements. A 1099 individual is someone who works for one company or maybe different companies, but not as an employee, and instead they get paid income and reported on a 1099 statement. With the 1099 statements, and typically for 2 years is where we start here, we're going to use the 10% expense factor, which means that if you have $100,000 that you show in your 1099 statement, we're going to use 90% of that, $90,000 for qualifying income for the loan. It's a very simple loan. I like this loan because of simplicity. And if you have a CPA, once again, we believe what they say, who is willing to write a letter that shows that you have a 5% expense factor associated with your business. You're effectively self-employed as a 1099 person. We'll use 95% of the income showing on your 1099 as qualifying income for the loan. We typically, as I said, get 2 years. It's possible we can get less than 1 year. And the situation that can work with that is when some individuals were W-2 employees with a particular company, and now they go to 1099. And if we can get a letter from the employer saying, yeah, they're still doing the same job effectively, but they're just not on the payroll as a W-2 employee, we're paying them 1099, we can use less than 1 year and use the 1099 and see the number of months and potentially make it work that way. If you have multiple 1099s, so let's say you work for 3 different businesses doing a similar kind of thing, whatever it might be, and you get a 1099 from all of those, we'll be able to add those together and use all of the 1099s potentially for the income. That didn't work for you. Instead, you have 2 to 6 months of bank statements, and now you have a CPA gross receipts letter. What does that mean? Well, it means, first of all, that you're going to give 2 to 6 months for the bank statements, and I'll explain the difference in just a minute here. And we're going to get a CPA in this particular case to write a letter that shows the gross income on the top of your Schedule C. So instead of putting all the expenses in there and having a net income calculation, we're just going to take a look at the gross income, what the business calculates. The CPA is going to write that up. The bank statements are going to need to support that. The CPA letter needs to state how much of the business you own, how much the total gross income is from the most previous tax year. All we're asking them to state on this letter is what your gross income for your business was last year. They go to your Schedule C if that's what you use. They look at the gross income at the top. They write a letter that shows that, how much of the business you own, and the fact that they filed the tax return. And that's the 3 items that we need to see on the letter from the CPA. Then we're going to take a look at the 2 months of bank statements that you provided us. We're going to see that their deposits there are equal to or greater than 85% of the gross income on a monthly basis. We'll take that gross income, divide it by 12. Those bank statements on a monthly basis need to be 85% or more of that, and we can use that for qualifying income. If the tax return they're using is not last year's tax return because it hasn't been filed, but they're going to use the prior year, then we simply get 6 months of bank statements instead of the 2 months of bank statements to show what the income is for the last 6 months. So maybe 12 months doesn't work. You see here, there's another option. 6 months is pretty strong. CPA can give you a letter for the gross income there instead of doing the 12 months of bank statements. This might work. And once again, if you have multiple companies, we can potentially use that. So I have clients who have 3 and 4 companies, and it can be challenging for them because one of the companies might be really strong when we look at the tax return, but some of the other companies are not. We're going to add all the income together, and that may be a problem by using the tax returns. But instead, they may be able to use this kind of a loan with the bank statements and a gross income letter from the CPA. All right. Number 7, it's called the asset depletion loan. We're talking liquid assets here. We take eligible liquid assets and we simply take all of the assets and add them up, and the eligible one, and we're going to talk about that in just a second here, what that means. Divide that by 84 months. You don't have to have income coming from these liquid assets. You just have to show that you have them. We'll do an income calculation as if you were able to pull income off of them. We use 84 months in this particular one, and that is your qualifying income for the loan. We can use 100% of the deposits, 100% of the balance in your money market and in your bank statement accounts. We'll use typically 80% of stocks, bonds, mutual funds, and retirement accounts because those are variable. They go up and down. If you're less than 59 and a half years old, you're too young to retire, we'll use 70% of the retirement accounts. So we just take, like, you have $1 million in your retirement account, 70% of that is 700,000, divide that by 84 months. That can be additional income that you can add for qualifying income. And once again, you can take this particular loan program, asset depletion, and you can calculate income there, and we can use that with other forms of income, such as W-2 income, to maybe get you over the top of the hill to qualify for the particular loan that you're looking at. Let's say that doesn't work. We have another loan, which will focus on IRA and trust income. And this is not a 401k because remember, we're talking about self-employed borrowers here. So this is people who have individual retirement accounts or they have a trust account. If you're 59 and a half years, less than 59 and a half years of age, we'll use 90% in this one. Notice that the guidelines are different with different loan programs. So if there's anything I want you to remember here is that there are plenty of options out there. They can change as things move along. So what I'm talking about today may not be there tomorrow. And you simply need to talk to a loan officer who knows these programs well and show them your particular situation and see if it fits. This particular program, as you can see, if you're less than 59 and a half years of age, we use 90% of the asset there. And notice this, we'll divide it by 36 months. much less than the 84 months for the previous example here. You get a 3-year continuance there. So that's what we're looking for. If you pull money out of there, could you pull it out for 3 years? And what would it be? And that would be your qualifying income. And as I've been mentioning with other loan programs, you can potentially use this loan with other types of income as well. Flipper income. So those of you who flip homes, we now have a home for you potentially. Now, when on the flipper loan, I'm not talking about fixing and flipping. This is not a loan to help you buy a property, fix it up and flip it. We do have that loan available. That's not this loan. This is the loan that you're going to use to qualify to purchase a home with longer term financing. And you're a flipper. A flipper to us in this particular case is defined as somebody who's done a minimum of 2 flips in the previous year. So if you did 1 last year, you don't qualify for this. If you did 2 or more, then you can potentially qualify for this form of income. What we're going to do is we're going to get the closing statements from the purchase. We're going to get the closing statement from the sale, because remember, it's a flip. So you bought it in some manner, and you need to go through escrow and have a closing statement there, which is going to show what the purchase price was and the cost. You sold it. We're going to be able to see the closing statement on that, and we're going to be able to see what you made in that property. You can potentially use up to 50% of the net income that you made on your flips and add that to your qualifying income. And once again, yes, indeed, you can combine that income with other incomes. I want to mention here, while we're chatting about this, that these are general guidelines again for the loan. So when I say you can potentially use up to 50%, if you have to meet certain guidelines to be able to use 50%. And if you don't meet those guidelines, then it's usually credit and it's usually loan to value driven. So how much down payment you're going to put on the house you're buying. You may not be able to use 50%. You may be cut down to 25% or some other number. And so be aware of that, and the situation can change depending on your situation. Okay, one of the most favorite loans for some of my investors who purchase property is called the DSCR loan. Some of you know it. We've coined it the simple loan because it is a very simple loan. You use just the income on the property. DSCR stands for Debt Service Coverage Ratio Loan. It is a loan that you can use the income on the property. So obviously it's a non-owner occupied loan only. You cannot use this loan to purchase an owner occupied home. We need to have rental income coming from the property. The rental income can be short-term rental income because it's becoming more prevalent over the last number of years, or it can be long-term rental income. And there's a different way we're going to take a look at those. Just be aware of that to calculate the income. There doesn't have to be a tenant in the property when you purchase a property here. If the tenant is not there, then we're going to ask the appraiser to tell us what the market rent is for that particular property, and we're going to use that as the income on the property to qualify for the loan. If there is a tenant there and there's a lease agreement in place, and the lease agreement agrees with what the market rent is, what the appraiser said, it's easy because they make sense. Sometimes the lease agreement is more, and if that's the case, you're going to have to show that that tenant's been making those payments for a number of months. And I say that kind of loosely because different underwriters have a different interpretation of what that means, but 2 or 3 minimum, 4 or 5 potentially, or more. And if you can show that, then we might be able to use the higher income to help qualify for the loan. We're only going to use the income from the subject property as the qualifying income. So I did a presentation to a group of investors recently, and I was able to put it on the screen. I should have put it here for you guys. The loan application itself, when you fill it out, asks for income on one page. And when you have a job or maybe multiple jobs, that can be a very large number of jobs put on one page and a whole bunch of data and a whole bunch of input in there. With this particular loan, there is no income stated on the application for anything. So those spots where you normally put income are left blank. How about that? We only look at the income on the subject property as the qualifying income. Even if you have other properties, we're not going to use the income to help qualify for this particular one. The desire is a 1-to-1 ratio. That means that we want the income on the property, the rental income, the gross rental income. You rent the property out for $2,500 a month. That's what we're going to use, to be equal to or greater than the total mortgage payment, principal, interest, taxes, insurance, any other things associated with that, like HOA dues or anything like that. So we would like the income to be equal to or greater than the total mortgage payment that you have on a property. However, for those of you who don't quite make it, you can go down to as low as 75%. that means the income of the property is only 75% of the mortgage payment. And as I mentioned, exceptions happen here. So what's going to happen there? The lender is likely going to reduce the loan to value. So if you're purchasing a property or refinancing, you choose to get a refinance. I find this happens. You're not going to get as high of loan to value as if you have a 1-to-1 ratio there. And also, because it's a little riskier loan from the lender's perspective, the rate's going to be higher to offset the fact that they're willing to do it at 75%. Also, by the way, some of the lenders have 1.25%. So you multifamily people who are really used to that, that happens here in the single family world as well. And the rate will be a little lower if you can show that you have a better debt to ratio there. This particular loan is typically 20% down or more for non-owner occupied on a purchase. 15% down is available now with one of my lenders, but I don't think they've had one work yet because they want the 1.25% debt ratio. The rate's higher because the loan is 85% loan to value. It's one of those situations where loan to value impacts the rate again. And so it's difficult to make it work. But if you think it does work, that is available to you. There's one thing I wanted to state on this loan, which was the short-term rental income. Short-term rental income it's kind of depends on what underwriter and what lender we send it to, but basically we are going to take 100% of the short-term rental income, if it can be verified with an appraiser that it's solid for that area. And what we have to do sometimes is go to the Airbnb data, and there's a site called airdna.com, which we have to go look at and see what the long-term, which means the short-term rental income over a year is going to be, because it cycles up and down depending on summer and winter. And we'll use that as well and potentially use 100% of the income. If not, some lenders are going to only use 75% of your short-term rental income because we know that it's not always occupied. Okay. And the 11th way, yes, we do have a no ratio loan. It is only, oh, I shouldn't say that. I have an owner occupied one that's available now, but not in Washington State. It is available in some other states where you can buy an owner occupied home, not state any income, do no ratio loan, and purchase a property. And we now have one for non-owner occupied as well, which you can not state any income and potentially purchase a non-owner property. There's no income on the loan application. It requires a minimum currently of 35% down. See, there's an offsetting thing here, right? If the lender is going to perceive the loan as more risky, and if you're not going to state income, that's considered a more risky loan, then they're going to demand something in return, a higher down payment, and also the rate is going to be higher. If it's I should mention this on all the non-owner. Most of the non-owner, all of non-owner have prepayment penalty options available. So typically you can have a prepayment penalty on a loan up to 5 years on non-owner. You cannot, regulation state, have a prepayment penalty on an owner occupied. You don't need to worry about it there. But if you're purchasing non-owner and using these alternative loans, usually you'll accept a prepay. And typically that's fine with my clients because they know they're not going to sell the property for a 1 or 2 years or refinance 1 or 2 years. So they'll take a 1 or a 2-year prepay instead of the 5. The rate is lower if you take a 5-year prepay than if you take a 4, than if you take a 3, and so on. The rate is substantially higher if you take 0 prepay. It does exist on non-owner. You just pay for it up front. There you go. 11 ways to verify income for the self-employed borrower. They're all on the screen right there. So please vote for me. Put it in the chat box now on particular ones. And I do see some of you put it in there. Thank you for doing that. We're going to use your voting to help us to identify which of these particular programs you'd like to get more information on. We're going to go much deeper and not cover so much ground on all of the different loan programs in the future here once we know which ones you like. Again, if you're on a YouTube channel, put a comment down below, please, and let us know which ones you like there. That'll help drive for the future here.